Well, welcome back to the Dallas Banker Club show. I'm Dean Rosencrans, founder of the Dallas Bankers Club. I've got a really special guest here, one of the originals of the Dallas Bankers Club, one of the ones that has always been here and very supportive of the club, Paul Patrick with Huntington Bank. It's good to have you on the show, bud.
Thanks, Dean.
Good seeing you.
Pleasure to be here.
Yeah. Well, listen, we've been in this market for a long time, and you've seen a lot of different changes in Dallas. You've always been on the ABL side, or no?
No, actually, I came down in '86 with Credit du Nord, which is part of Bank Paribas. So I was in energy lending. So I had hit that cycle in '86 through about '94. In '94, I went to Finova Capital, went to ABL, or as I say, the dark side of lending.
Well, you know, ABL does serve a purpose for sure, but you have to be a specialist at it. I mean, not everybody can be an ABL lender. So you and I were at Capital One for, well, I was there only a few years, but
Right.
How long were you with Capital One?
I was there about 10 and a half years.
10 and a half years, kind of the starter of the ABL group there.
Right. They bought 3 banks. I was part of North Fork, and then they bought Hibernia Bank, and they bought Chevy Chase.
Right.
So it was a 3-bank roll-up.
So now you're at Huntington.
I'm at Huntington. I started in late December, early January. The bank's been around for about 150 years. Mm-hmm. The joke is I tell my first 2 customers were Sacagawea and Lewis and Clark. When they were traveling the Continental Divide, right. They had to cash a check to get, pay some of the stuff for
That's right.
supplies. And
so they weren't your customers.
No, they were not. They're probably key banks. Anyway.
That's right.
So the bank's been around 150 some odd years, and it's a nice super regional bank, about $110 billion in Columbus, Ohio.
Sure. Yeah. So tell us a little bit about what your profile of client looks like for Huntington. Reggie was in a little bit ago, Reggie Goldsmith, who manages the commercial side, and he kind of shared with us that it's kind of a methodical build, a strategy by which get your brand out, and then at some point, hopefully the business will come. Same with ABL, I would think, or
yeah. This isn't what we consider to be the footprint. The bank's in Columbus. It's very well known in the I'll call it the Rust Belt, mm-hmm. Ohio and Michigan and Indiana area. They have built 12 ABL offices from Cleveland, that's where we're based, the ABL side, mm-hmm. to the East Coast. And they were looking to get into the Dallas area. So we now have offices from Dallas up to Wisconsin, all the way out to the East Coast.
Do you just cover Texas, or do you go all over?
I cover pretty much the contiguous states.
Okay.
And Louisiana and Texas and Oklahoma. But I also picked up Denver.
Oh, really?
So I'll cover Denver, but there's nothing to stop me to going other areas. So mm-hmm. Our business is a national footprint. So we'll do business wherever that client has a company.
Sure.
So, but I primarily focus on the investment banks and private equity guys that are in the greater Southwest territory. That's where we get our deal flow.
So give us an example of a sponsor type deal that you would do. That really kind of fits your wheelhouse. And then give us an example of a deal that wouldn't fit.
Okay. Most of the companies we're looking for are revenue size about 15 to 20 million. EBITDA probably 4 million on up. Mm-hmm. What we're looking for is, manufacturers, distributors. Somebody has some asset values and what I'll call working capital assets, mm-hmm. which it's going to be account receivables and inventory.
Sure.
So we'll put a revolver in place against those credits, those assets based on some formula. Mm-hmm. And then we'll do a term loan on the plant and equipment,
sure.
or real estate, and we'll have that amortized. Mm-hmm. So I would say anything that's got a good asset base with fairly positive earnings, it could be a turnaround story. It doesn't have to be highly profitable. It could have a hiccup. Sure. I'll call them the story credits.
Right.
And we'll build with that company. They're usually not bank credits. And if it's private equity guys, it's usually a little bit more leveraged than your traditional bank deal, where Reggie or yourself might be looking for 3.5 times leverage. We'll do more leverage deals, mm-hmm. as long as the collateral value is there.
Right. What would be a maximum? I mean, would a 10-time levered deal be still okay as long as you're covered by asset?
Well, it's, that would be a combination. Probably not. I think 6 to 7 is probably more realistic.
Sure.
Because some of that debt's probably going to be subordinated.
Mm-hmm.
So that extra 3 or 4 turns above 5 or 6 is going to be subordinated to us, interest only.
Mm-hmm.
Whereas we will come in and do the senior side and hopefully get paid the principal and interest. But we're willing to do sponsor-driven deals, and those deals can be 6 to 8 times leverage, depending on how much equity they put in and how much mezz debt.
Right.
So the deals we won't do generally are companies that have their construction, their progress billing, where you have to complete a project to get paid.
Would that also fall into contract manufacturers?
Probably. But there are some contract manufacturers that do some business and turn it very quickly and then move the... So if they do it short term and they move the product and we can create an account receivable very quickly, we would look at that.
Mm-hmm.
The other one is, is pretty much oil field services.
Right.
I think, having been coming down 86 and seeing that downturn and upturn, and we were going to 102, and now we're back to 30, and now we're back 60, 70.
Sure.
So we won't do a lot of oil field service equipment, the fracking and stuff that generally gets kicked to the curb when there's a downturn.
Right.
So we don't want to have our assets
sitting out there.
Sitting out somewhere in Odessa.
I hear it. Well, I seem to recall that you are also on a turnaround management deal. Tell us a little bit about what turnaround management means and what is this group that you're on the board of?
Okay, well, you've got a good memory. I'm on the Turnaround Management Association. It's probably about, I think, 15,000 people. There's probably 30 chapters. And in the Dallas-Fort Worth chapter, I'm on the board. I was past president way back. What they do is it's a association of a lot of turnaround guys. So they'll bankruptcy attorneys, turnaround consultants, workout groups, appraisal companies. These are usually companies that had a problem either in the downturn or something. And so these professionals, I don't know if you ever watched The Profit with Marcus Lemonis there, who's trying to invest.
Yeah.
This is kind of that, but it's a broad-based group of people who get involved in helping companies turn around and save jobs, maybe have a capital investment. There might be some distressed equity guys that come in to look. So we have 230
people. So it's just not a bunch of hired guns. It is a little bit of hired gun with some capital behind them to try to turn a company.
Yeah, there's lots of stages of companies that go through growth, and then there's some downturns. But there's a lot of people who do bankruptcy and restructurings, and also distressed debt, including distressed equity funds, who will put money in. So we have about 230 local people in this chapter, and there's probably about 40 chapters in the U.S. and there's some international as well. So it's a good group thing.
So I remember when we worked at Capital One together that we would often share the stock picks. So what's the latest one for your portfolio that's going to turn around and make you a ton of money?
Dean, I'm pretty much in cash. At this point in your life, you want to kind of sleep well at night. So there's probably some opportunities out there, but I think the Dow Jones is hitting some all-time highs. I think everybody's baked in a rate cut here. Not sure that's going to happen. Could happen. And the economy still seems pretty strong. Everywhere I travel, I see a crane, I see building, I see road construction.
Yeah.
So I don't see the downturn in the economy to
So with your market that you're covering now between Texas and Colorado and Louisiana and some of these other markets, are they all experiencing growth like Texas, or are we still an anomaly in our country with the Texas market?
The markets I cover are still growing. I think Denver's still booming. I don't know how the bi-coastal areas are doing, but it seems to be there's still a lot of money out there. The job growth and unemployment levels are very low.
Right.
People are employed. There may be some people moving out and transitional of job changing. But things are moving smoothly. I think when the election comes up, there'll be some uncertainty, so some companies may draw back on CapEx spending for a while. And we're starting to see a little bit of that. I think people are, scared of uncertainty.
Yeah.
But right now, things seem to be going really well for the companies. And it's very tough to find new business because most banks want to keep their customers.
Right.
And there's not a lot of turnaround business right now.
Well, that's true. But, I was having lunch with another banker this week, and we were talking the difference between corporate commercial banking, the traditional C&I, versus some ABL deals that have been done out in the market. And I remember when I was at Wells and we had Foothill and Business Credit, and those were deals that would typically have LIBOR 400 type spread with fees and
collateral monitoring.
Yeah. And what I'm hearing is that a lot of the ABL deals are almost no fees in the LIBOR 200 range, which is very competitive for what most people would think would be a levered type of a transaction. What's happening in ABL? Is it because we're so competitive that everybody's going after and chasing each other down, or is that just that's what it's going to look like going forward?
That's a very good question. But when you started talking about Foothill and I think Finova and CIT, a lot of these companies were unregulated and were not owned by banks. And over the last several years, a lot of these companies, and Foothills, they're owned by Wells Fargo. Finova's no longer here. CIT's now morphed into a bank.
Sure.
So a lot of these players in the ABL side are now owned by banks.
Right.
There's very few non-bank owned and non-regulated. Now there is Encina and Sienna, and those guys are at the LIBOR plus 6 to 8. But Huntington Business Credit and a lot of the other ones have bank sources of funds.
Right.
So we're looking for good clients. We're able to bring in a cheaper source of funding, but we have to have the structure and the reporting thing, and usually Treasury and the lockbox services.
Right.
But I would say we can compete with banks, but we're not going to be at the LIBOR, below the 2 level otherwise, because you have a certain cost of funds, you have regulatory costs, you have corporate overhead, as you know.
That's right.
So the pricing models have changed because a lot of the ABL guys are owned by banks now.
Well, and one of the beauties of, there are certainly distinct differences between an ABL deal and a commercial deal. Commercial deal, typically, you're going to have covenants, and you're going to have a lot of negative financial covenants on a deal, whereas our ABL deals with Cov Light, but are they still no covenants? That's still there's an offset there. You're either going to have a commercial deal and maybe have a lower rate, or you can have an ABL deal and you're going to have more availability, better advance rates, and just less. What am I saying?
Covenants. Yeah. Well, the difference, and I've been on both sides. From the banker's point of view, you're generally going to get some kind of an owner's guarantee or some support level. And you'll have a leverage test and a fixed charge coverage and maybe a working capital test or something. What we do on the ABL side is we have asset values, ultimately, but we also need cash flow. So what we're truly looking for is we don't look for personal guarantees, but we do run background checks and everything else. What we're truly looking for is a fixed charge coverage test. And that's really the only test we need.
Right.
Because as long as the company is able to service a fixed charge.
Is that typically written into the agreement, or it's just kind of a,
no, it's written into the agreement.
Okay.
It's tested monthly. And we can start, generally it's a 1.0 or 1.1 trailing 12 months coverage.
Sure.
We can start below that level if there's been a story and a credit issue, but it has to build to a 1.1 over a period of time, at least in my institution. But I think most ABL lenders are very similar. We've kind of learned the craft from guys who've been through this. True ABL started with the factoring and the garment industry way back when. And factoring then morphed, and then you created ABL from the factoring side. Right. So they do the AR, they did the inventory. Now we do a little bit more.
Well, what we do see a lot of anymore is Cov Light kind of deals that don't really fit our world, but
springing covenants. Yeah.
And it's oftentimes that we can't participate in something like that. Not that it's a bad deal, it's just not necessarily structured the way a traditional commercial bank structures deals. Well, listen, man, you've been a great supporter of the Dallas Bankers Club. We've been friends for a while, and I really appreciate coming onto the show and having more of these types of discussions in the future as well. So thanks for coming in.
Thanks, Dean. You've done a great job. This, I think, is a tremendous networking thing that you've put together. I think it's getting momentum, and if you're not part of it, I feel sorry, because it's a great networking.
Well,
great job. Thank you for having me.
Well, that's the final segment of the Dallas Bankers Club show this evening. I think there are no more bankers left in the room next door, and if they are there's who knows. So next time, our hope is that we're going to have a charity event coming up in September, possibly October. But stay tuned for that as we try to put that together. And if you have more or would like more information about the Dallas Bankers Club, please reach out to myself at dean@thedallasbankersclub.com. And we look forward to seeing you at the next event. Cheers.